Okay, I'm not even gonna lie to you guys. I was sitting back, relaxing, eating this watermelon, like the best watermelon of my entire life. Almost spilled the bag to jump to the computer as fast as possible when I heard this new clip from Tom Lee. Holy moly. To watch this, and literally the whole thing, because there's a lot of great context that he just provided about where we are in our markets.
NVIDIA and the AI-powered rally showing little sign of slowing today, with the chipmaker hitting an all-time high. The Nasdaq closing above 17,000 for the very first time. NVIDIA is up nearly 20% since its earnings report just last week. And check out some of the other names in the chip sector hitting all-time highs today. Micron, NXP Semi, Qualcomm, and Texas Instruments. So, should investors count on NVIDIA to keep driving the market higher? Joining us now is FundStrat's head of research and CNBC contributor, Tom Lee. Tom, good to see you. So, you're still bullish heading into June. You say there's too little investor confidence, too much cash on the sidelines, but it seems to be flowing in now. So, how do you invest and not get burned by volatility?
Well, it has been one of those years where, investors have been hesitant all year, and I think we have had some short pullbacks, but I think the best strategy for investors is to really stick with what's working, and what's working is AI-related names, whether it's NVIDIA or highly correlated stocks like Cadence or Supermicro, the Ozempic-related trades, industrials, financials are doing great, and the Bitcoin and the proxies as well as, I think, a growing small cap stealth rally. So I think there's still a lot of ways to be invested in this market.
The small caps have been hot to the touch, though, not in a good way, especially with yields occasionally spiking. So are there certain areas within small cap that you'd say average into, or how are you treating them compared to the mega caps?
Well, small caps, I think, have been very sensitive to the probabilities of a Fed cut. So I think they're very sensitive to actually when the Fed begins cutting. And, the last few comments from the Fed have actually hurt small caps because the odds of a June cut have been pushed out, and maybe, the odds of a September cut are, diminishing. So I think that weighs on small caps, but it doesn't take away from the fundamental attractiveness of small caps. Earnings growth is close to 19% in the median Russell 2000 stock, and the median PE is 11 times. So you're getting far better earnings growth in the S&P and a much lower PE multiple.
What's incredible about that, Tom, is the fact that we went from, at the beginning of the year, a market that was aggressively pricing in this flurry of rate cuts to now a market where stocks are continuing to move higher as investors digest the possibility, or I guess are hoping for the possibility, that we have a Fed that doesn't raise rates again before the end of the year. That seems to be the thing. That's sort of being taken as the thing. Every time Powell or somebody else comes out and says, we think the peak is in, we don't think we have to raise again. We've really seen an incredible pendulum swing, and it raises the question, how much now hinges on earnings if that's going to be the scenario?
Well, I think that's spot on. First, the number of expected cuts has shrunk, but it's really shrunk for the right reasons. The economy's been good. Inflation is progressing, maybe not the speed anyone would like, but the reality is, 3% or even 2.7% inflation is really good for corporate profits. So I think the earnings outlook actually is far better than most expect. You can see the beats by NVIDIA as an example, but S&P earnings next year, maybe if consensus at 270 something, it might be closer to 280. So you can see why there's upside for stocks.
We just had the S&P close at 5306 today. I believe your year-end target is still 5200. Does it need to come up? How are you thinking about it?
Yeah. Our year-end target is too low because, next year's earnings, if it's 280 and you put a 20 multiple, that's way above 5200. But it's only early June, and I think we're still just deciding whether or not there is a speed bump between June and December. But yeah, I'd say 5,200 is too low.
Tom, how do you treat the weight loss and overall health trade epitomized by Lilly? It's up at real highs now, $750 billion market cap, but it's been bouncing around in this range for about 3 months.
Yeah, it's I think a lot of large cap stocks that have been leading show similar patterns of sort of consolidation. And, I think it would be too early for someone to say that, Ozempic and the GLP drugs have peaked. So to us, it's really an opportunity for someone to be accumulating. I don't think it looks that different than Nvidia into earnings or, many of the stocks that have broken out recently.
U.S. stocks, is that really the place to be right now? Or are you looking abroad as well, especially if you do have an ECB, for example, that's going to cut before the Fed?
Well, it's nice to see other central banks cutting because, from our perspective, inflation probably is tracking better than most expect. But I think the best companies, especially in technology and financials and healthcare, really mostly are in the U.S. So I'd feel a lot more comfortable recommending investors stick with the best companies in the U.S. rather than try to buy something outside the U.S. because of relative valuation.
So with everything you heard there, what's going on with small caps? Now, yes, clearly he said stick with the AI trade, with Ozempic names and industrials, healthcare, whatever that's working, or financials, not healthcare, financials, industrials. Okay, blah, blah, blah. That's kind of what we already knew. I think it's a little bit of reaffirmation for some people that think the AI trade may be a little exhausted at this point. It's clearly not. I mean, take a look at Nvidia. Nvidia was up about 7% today. If Nvidia was not up 7% today, AMD up 3%, and some of your AI, adjacent names were up as well, it would have been an even worse day for the markets. And I think a lot of people feel the same way as Tom Lee right now. A lot of you guys, if you are in your AI trades, you're doing very well. And I think generally speaking, you ride that trend until it doesn't work anymore, until you can't any longer. But I actually think what Tom Lee said about small caps is probably more relevant to more people. Because I think a lot of us have spent the last couple of years buying the dip in names like PayPal, maybe SoFi, other stocks like that have not done anything in years. And I know a lot of you guys might be frustrated when you hear investors and institutional investors talk about how great this market is and, stocks continue to hit new all-time highs, when in all reality, your portfolio is probably not. That's because we've bought these names that are, high quality names. They're great companies. SoFi, PayPal, companies like that, CRISPR for that matter. These are companies that are, if not changing the world, fantastic companies that are growing, quickly, right? Growing faster than the average stock in the S&P, but they still can't catch a break unless one thing happens. The markets start to price in rate cuts. From about November 1st through the end of December of 2023, those areas of the markets did pretty well. I mean, CRISPR got up to almost $90 per share. PayPal was almost in the 80s. It was a pretty good little rally period for those kind of stocks. And that is all dissipated. Okay, PayPal's in the 60s, CRISPR's in the 50s. It's been bad. SoFi's in the $6 range, just to pick on a couple of them. But what did Tom Lee say that has me excited about this sector? Well, obviously, Tom Lee tends to be very correct on basically everything he says, and his track record goes back a very, very long time. Back to 2017, he was calling out some of these stocks that are, much, much higher today. So I would say that's exciting for me personally, with a lot of my net worth in some of these beaten down names, some of Tom Lee's granny shots, like a PayPal for that matter. I also think another exciting aspect of what Tom Lee said was the recognition of the growth. Now, the growth in some of these names are 19% on average for small caps, like Tom Lee said, well outpacing earnings growth for the S&P 500, trading at a fraction of the multiple of the S&P. You're trading at a third of the multiple, close to a third of the multiple of the NASDAQ, the small caps. And in the third and fourth quarter of this year, Tom Lee did not mention this as much as maybe he probably wished he did, or just assuming, the growth rate is going to really accelerate on a year-over-year basis in Q3 and Q4, and that's going to make these stocks look even more appetizing. Now, another reason why small cap stocks have been so beaten down for so long is, even though if you look at the NASDAQ and S&P at all-time highs, you know this is a very concentrated market rally. If you were to take out Nvidia, Meta, Apple, Microsoft, Google, the markets would have done a whole lot of nothing over the past couple of years. It's been a concentrated rally. And why is that? Well, okay, think about it like this. This is the simplest way to put it. If you go into a recession, which companies are going to do the best? Magnificent Seven. They're the ones with the most established consumer-based or customer-based companies that other large companies need and depend on. Which companies are going to get hurt the least or actually benefit from the Fed raising rates and keeping them higher for longer? Magnificent Seven stocks. Because why? They have, tens of billions of dollars of cash in the bank, and they sit back and collect their sweet, sweet interest. Those are two reasons, and the main reasons why these stocks have done well. You've since added, sprinkled on top, some AI hype, or, I guess it's not hype for Nvidia, but for all of the other ones it is. They're spending billions of dollars on GPUs. They're not selling a product, a service to anyone bringing in anything close to that. Besides Nvidia, let's be honest, AI is pretty hypey. Okay, Nvidia kind of justifies the hype a little bit, and I'm not here to, bag on AI. I think AI is the future. I just think it's been a little sprinkle on top of the markets, besides Nvidia, that has really helped these stocks out as well. So you have AI working for you for these Magnificent Seven companies. You have recession resiliency. I'm not going to say recession proof, but resiliency. And you have these companies that benefit from the Fed staying higher for longer. Now, what changes this? And when do small caps and just average stocks get their turn in the spotlight? Well, let me say it like this. The same things that benefit Magnificent Seven start to hurt Magnificent Seven, start to hurt the sectors of the markets that have done the best when rates start to fall. Now, question is, does the economy stay strong enough to kind of keep away some of those recession fears? I personally think so. Maybe. The data is not concise enough. There's some metrics that you'll just look at and, gasp at, like consumer confidence or manufacturing data or commercial real estate. There's different sectors that look terrible. The consumer's really starting to become shaky as well. You see that with McDonald's, with Walmart, with Target, all of these consumer companies, especially your high end, not your discounters, but your higher end, companies like a Restoration Hardware, for an example. Home Depot, Lowe's, they're not doing too great either. But when you look at this in a whole, it's kind of like this rolling recession. It's like certain areas are in a recession at some periods, they come out of it, other areas go into it. It's not enough to cause that recession fear, that recession panic. It's not showing up in the data. Maybe it will at some point. Then small caps and mid caps are not going to do well. I think a good base case scenario at this point, especially during an election year, is we're probably going to get some cuts. The economy's probably going to do okay, because that's the last thing you want if you're up for re-election and a recession is coming. So I believe the first cut from the Fed is coming July 31st. I think over the next two inflation readings, one of which we get here on Friday, which is core PCE, will continue to show progress. And imagine it like this. What if we get, for an example, this Friday, we're expecting 0.2% core PCE month over month. Great. What if we get in June another number that's maybe 0.1%? Maybe coming by July 31st, expectations are we're going to get a, 0.1 or 0% month over month change for core PCE or CPI for that matter. The Fed's going to be cutting rates by July 31st, let alone what the economy is doing. If the economy weakens or consumer weakens more, they're going to start cutting rates. Now, again, you want to keep the economy strong as long as possible. That's kind of what Tom Lee was saying here in this clip. But that becomes a very favorable market environment for small caps. Instead of interest rates being a headwind for small caps, they turn into a tailwind, something that can push those stocks higher. Whereas rates being higher for Magnificent Seven, the area of the market specifically that has done very well in the past couple of years, it's no longer a tailwind to keep rates high. It becomes a headwind when the Fed starts to lower rates, because that's going to hurt those sweet, sweet profits that these big tech companies are making from all of their cash in the bank. Now, at the same time, there's something called money market funds, and we see how much money is in these funds at any given moment in time. Currently, there's almost $6.4 trillion in money market funds. This was last updated for Q4. We're going to get a new update here in the next couple of weeks for Q1, and I'm sure this number went even higher. Now, when the Fed starts to cut rates, you start to get less yield on your money. So that means incrementally, you're going to start seeing capital actually leaving money market funds. You have $6.4 trillion in money market funds. I mean, if you even get a fraction of that, 1/10 of that would be $600 and almost $650 billion into stocks. That is a third of the market cap value of the Russell 2000. I mean, just a fraction of this money will have big financial implications for what stocks do. And what does big money like to do? They like to chase different trades in areas of the markets that will benefit from what's going on at that moment in time. If and when the Fed cuts rates around July 31st, in my opinion, that's a tailwind to small caps. And that will likely push a lot of that money market fund money into small cap stocks. Beyond just your AI, big tech names, coming hopefully by July. But something that is not talked about nearly enough in, on CNBC or other financial platforms, even YouTube, is when the Fed raises rates, it's very simple. The odds of a recession go higher. And that's ultimately why stocks even sold off in 2022. Because it raises the odds of a recession. Why did stocks do well in 2023? Or at least certain areas, because markets figured out, hey, these areas are actually benefiting from rates being higher. And if we go into a recession, we probably don't have too much to worry about in these specific companies. Your Magnificent Seven. Great. Awesome. Perfect. Bad for small caps. Bad for your average stocks out there when the Fed raises rates. It raises the odds of a recession. But when the Fed cuts rates and you're not in a recession, then it lowers the odds of a recession. And small caps are disproportionately affected by recessions. A lot more of them go bankrupt. It's a lot harder to raise capital. I'm sure you understand why small caps and, just average companies have a harder time than big tech, Magnificent Seven, during a recession. So each and every single cut we get also lowers the odds of a recession by maybe, let's say, 5% or so. And that makes it even more appealing, maybe is the word, to get into small cap stocks as well. So I think potentially here in the month of June, if the markets do start to actually look forward to the Fed being able to cut rates in July, which actually could happen by this Friday if PCE comes in lower than expected, that's probably when you see small cap stocks really start to outperform. And I love how Tom Lee put it, the stealth sleeper rally, because it's going to sneak up on people. And when it comes, it is going to be quick. Like, I would not be surprised if the Russell rallies 5% on Friday alone if we get a better than expected PCE report. But nonetheless, let me know what you think about this information down below in the comment section and what Tom Lee just said. Hit the like button as well as subscribe to the channel. I will get back to eating my watermelon now. Seriously, it's like the best watermelon of my freaking life. Hey, no more fire alarm detector beeping like crazy throughout the videos. So good news there. But yeah, you guys have a great rest of your day. Fantastic day, fantastic night. And I will see you right back here tomorrow.